Hello and welcome to Views from the Top. My name's James Marley and today I'm talking with Seb Mullins, who's the head of multi-asset at Schroders. Being the head of multi-asset, that means we're going to be looking across all asset classes today, talking about where the best value is from equities through to government bonds. We're also going to be touching on Schroders' modelling of recessions, really topical right now, and what that means for what they're seeing in the real economy. Seb, thanks for coming in and great to have you here.
Thanks for having me, James. Appreciate it.
Well, let's start with the interesting stuff, recessions. We love talking about them. Schroders has some modelling that you follow, a number of markers. Could you tell me a bit more about that modelling and what you're tracking?
Sure. Well, I guess most recession models usually have one or two inputs. They're pretty simplistic. So think about, for example, the New York Fed's recession model. That's just looking at the yield curve. What is the 10-year yield and the 3-year yield and what's the difference there? And that's trying to give you an idea of how tight monetary policy is. Whereas we think it's better to have multiple indicators within a model to give you a better understanding of how the recession probabilities are changing, but also giving you a clearer timeline over to when they might occur. So our main model uses 20 inputs, not just one. So 20 inputs, and they can be categorized in sort of three main buckets. One will be sort of inflationary. So is the economy overheating? Those triggers usually lead a recession by, say, 1 to 2 years. Then you have sort of the monetary policy response, so the other next third. And that's kind of like what are central banks doing to slam the brakes on given the overheating economy. And that typically leads by, say, 6 to 12 months. And then finally, the last third of indicators we have are sort of, what is the short-term macroeconomic or market impacts of things starting to break from that sort of higher monetary policy setting. So when you see those 20 indicators together start to sequentially trigger, it gives you a clear lead time. A, how is a recession likely, but B, how close are we getting to that endpoint? So I think that is a more useful modeling to have than, say, just the Fed's inversion, which is already 60%, but doesn't tell you when a recession might occur.
So let's stay on this theme. What's the model telling you right now about the prospect of recession?
It's quite interesting because it has been changing over time. And if you think about the overall model, once it triggers 40%, which sounds low, but any trigger over 40% of those indicators, there's always been a recession since 1990. So right now it's at 50. So 50% by itself is quite concerning. So that would keep us cautious on risk assets given the recession model is triggered. That said, it's fallen from a high of 65%, which was in April this year. So in a way, the trajectory is positive as it's falling, but it's still triggered. And I think what's most important to us and most interesting is that in April, when you had the banking crisis in the US, the SVB banking crisis, the imminent recession model triggers were triggered, suggesting an imminent recession 1 to 3 months out. That's all switched off now. So the model is still saying, watch out, there's a recession, but it doesn't look like it's imminent. So the model's pushed that recession indication out, say, by 6 months. So for us, being cautious but shorter term, it's less dangerous to be invested in risk assets right now, given the model's pushed out that recession call.
I'm keen to know, how does the recession modelling that you undertake feed into the actual investment process?
That's a great question, because it's a very interesting model to talk to, and everyone wants to know about recession, but it's not the be-all and end-all of an investment process. It's important, but it's not the be-all and end-all. So I guess our investment process can be summarized in what we call a VCL framework, which stands for value, cycle, and liquidity. So if you think about valuations, that helps you, A, determine which asset classes are attractive relative to each other, but B, it tells you what kind of risks is the market already pricing. So that's sort of the first part of our process. That feeds through to our forward-looking expected returns, which we'll talk about later, but also lets you know, for example, well, first of all, what assets are attractive, but it's pretty terrible at telling you when to invest. It's a longer-term metric. So valuations, where's the vulnerabilities, where's the attractiveness, but pretty bad at a short-term view. So we supplement that with the cycle. So for example, are we at the beginning of an economic cycle? Is there a recovery phase? Are we towards the end in the slowdown phase? That tells us how much extra risk we should take, or when we think those, well, how we view those valuations and whether or not it's pricing in what we see in the cycle, and also tells you where to invest between asset classes, styles, or even sectors or countries. So the recession modeling occurs in that cycle work. So it helps us understand, are we towards the end of a cycle and is it about to roll over? And finally, we look at liquidity, which is a shorter term metric, maybe so telling you what's happening over the next couple of months. And that's central bank policy, fiscal policy, how the market's positioned, what is the market sentiment. So those three things, value, longer term, cycle, medium term, liquidity, short term, all tell a story, and that's how we build portfolios. Yeah. So recession modeling is just one part of that cycle work we do.
Yeah. I'm interested to know, talking about liquidity, we've had this aggressive interest rate tightening cycle. Do you think how much of that cycle do you think we're now feeling in the real economy? What are you tracking?
It's been quite interesting. I think everyone's been surprised at how little has been priced into markets, or the economy is feeling that higher interest rate. People talk about long and variable lags from monetary policy, which is usually the case, but I think that lag has been longer than most anticipated this time around. If you think about it, most central banks globally have had the most aggressive rate hiking cycle in the past couple of decades, but you're not really seeing anything cracking or rolling over. Yes, growth is slowing, but you're not seeing a complete collapse. Like, for example, retail sales last night in the US beat all expectations. Consumers there are still spending, even though rates are extremely high. Even in Australia, you've seen manufacturing sort of roll over, but services remain very, very hot. So even though you've seen some mortgage stress in Australia with higher interest rates, floating rate mortgages, you've seen rent start to hurt given those higher rates, the overall economy doesn't appear to be rolling over. And in fact, some components are actually doing well. Savers who have cash in the bank are earning an income. So we haven't seen sort of the tightness or the rolling over or cracks you would expect to appear given how aggressive the rate hike cycle has been.
Yeah. You touched on it before. There's a lot of attention placed on the strength of the US consumer. Why is there so much attention there? Why is it so important?
Well, I think that's been the main bellwether of the US economy. So the US economy has done very well relative to expectations and also relative to other countries. And the main driver of that has been partly some fiscal policy, but mainly the US consumer has continued to spend despite higher inflation, despite higher interest rates. They're still out there consuming pretty aggressively. And I think for us, what's been interesting to note is that COVID has sort of distorted the picture. So back to your last question of have we seen the tightening come through the economy, the answer is probably no because of these COVID distortions. So if you think about just in the economy, you had rolling recessions. First services were hit, then manufacturing did really well, then manufacturing was hit, services did really well. That allowed the economy to sort of muddle through. But in the same time, consumer handouts, so COVID relief packages, meant that US consumers had a lot of cash sitting in their bank accounts, allowing them to spend into the economy. And if you think about wages in 2022, they started to rise pretty aggressively, but they're well behind inflation. So inflation was rising higher than wages, so real wage growth was deeply negative. But the consumer kept spending because they had all this cash sitting on the sidelines thanks to COVID handouts. Jump forward to today, you've actually seen real wage growth increase to be positive. So that means as long as you have a job, you can keep spending. But also some revised data from the US government has shown that that cash pile that consumers had was expected to be spent already has not been spent. There's still $800 billion left in excess savings, which means around 3.7% of GDP per capita can continue to be spent over the next 15 months. So even though wages are sort of rolling over, inflation's rolling over faster, so wages remain strong, interest rates are very high, but they can still spend on their cash. So as long as the consumer is flush with cash, their own personal balance sheet has improved, and their earning income has improved in real terms, they can continue to be a force to reckon with in the US economy.
So what does that mean for bond yields? We've seen bond yields spiking more recently in Australia and also in the US. Have we seen the top, or are people jumping at shadows?
It's the million-dollar question. I think if you think about, are we close to a peak? Well, we're a lot closer to a peak than we were a couple of months ago. Going from 0 to say 5% in US rates is a lot closer to the potential peak than we were before. But where rates settle at is still the question everyone's asking. Yep. You've seen a lot of volatility now because the expectation only a few months ago was the soft landing scenario, where inflation falls naturally, the Fed and other central banks can cut rates nicely without a recession because the inflation's rolling over. Where if you look at our models, the 10-year Aussie dollar 10-year yield, fair value models suggesting around 4.6% yield is about right, which is where we are as of today. The US 10-year yield fair value model is saying around 4.9, which are about 10 bips away from. Yep. So those models suggest we're close to the end. That said, however, those models rely on GDP inputs, monetary policy inputs, and also inflation, which are all still uncertain. Yep. So I think as we're seeing this higher for longer regime play out, the volatility in bond yields is going to remain high. Especially leading into the end of this year in the US, they've got the Fed, who are probably going to hike now, based on some of the things we've seen, which is not fully priced. And also, there's a lot of issuance of treasuries. For example, the US government is massively in deficit, they need to continue to spend, so they're issuing more treasuries. Both those things likely keep bond yields volatile and higher, but compared to, say, 6 months ago, we're closer to the end than we are beforehand. But volatility is going to remain over the next couple of months.
Okay. Well, we've got a bit of a backdrop to the environment that we're investing against at the moment. We're going to now get into where you do see value, what you like, what you don't like. But before we go into the specifics, I was hoping you could explain the concept of equity risk premium and how investors can use that to assess the relative value between asset classes.
Okay. Well, it's an interesting concept because if you think about comparing equities to bonds or cash, you have to have some sort of normalization to actually compare which is cheap or expensive. Yeah. So if you're comparing, for example, government bond yields to cash yields, you can see, well, what's the yield differential and what am I getting paid for? Yeah. So equity risk premium, first of all, you have to adjust equities to give yourself an earnings yield. And to do that, it's quite simple. You just inverse the P ratio, the price to earnings ratio. Yeah. So for example, if the P ratio in the US is 18, you get 1 divided by 18, you get around 5.5% earnings yield. Yeah. So that gives you a yield to compare against other assets. Now in a normal market, you should get paid for taking more risk. So a risk premium. Yeah. So you think government bonds should give you more than cash, corporate bonds more than government bonds, and equities more than government bonds. Right now, if you look at equity risk premia, you're actually not seeing necessarily extreme value in certain countries. Mm-hmm. So look for the US, for example, if you compare its earnings yield relative to cash or 10-year government bonds, it's around zero. It's not being paid anything extra on taking higher risk. Yep. And if you compare it to, say, the 30-year average, it's well below the 30-year average. So it's looking quite expensive. Equity is looking quite expensive relative to US cash, relative to US bonds.
And what about in Australia?
Australia looks more healthy, to be honest, because it's not as expensive. The market is below its sort of average valuation. So it's around, say, around 2% above cash and bonds in Australia, which is around the 30-year average. So it's not screaming cheap, yep, but it's around the 30-year average, whereas the US is deeply below the 30-year average.
Okay. As I mentioned, you run a multi-asset fund. You get exposure to equities, fixed income, credit cash, all those asset classes you've talked about. Can I get you to rank maybe the top three? Like, where are you seeing the most compelling value across the asset class spectrum at the moment?
So for us, we're trying to find areas we can actually get a nice return while we're sort of waiting for this volatility to play out in markets. So if you think about, we talked about bonds and where interest rates are going, it's very volatile, and it's hard for us to invest there right now. With equities, given the valuation distortions as mentioned, especially in the US, they don't look as attractive as you'd hope to see. So for us, we're trying to take what can we invest in now when the volatility is remaining high? And we're buying credit. So investment grade credits we think is attractive. There's some duration risk there, but it's lower duration. And if you think about Australian IG credit, investment grade credit, it's yielding around 6%. And it's very high quality companies. We don't think it's going to go bankrupt. Yeah. If you model what kind of default rates you're getting compensated for, a few months ago you're getting paid more than you'd break even if you had a recession type of default rates. So for us, it was attractively valued compared to other markets. So we do like credit. Yeah. Given the volatility in rates, maybe floating rate credit would also be attractive. But for now, we're earning what we call carry-in portfolios while we wait to see what plays out in the other asset classes. So probably credit's on number one asset class. Number two is probably select equity markets. Yeah. So overall equities, we still think a challenge given valuations and given that recession. But places like Australia, we mentioned, and even Japan look quite cheap, relatively cheap to the rest of the market. And Australia, you can earn franking credits as well. So we do think certain equity markets like Australia and Japan are attractive, but overall equities we're still cautious on. And it's going to sound boring, but cash is paying you something now. So you're getting 4+% in Australia, 5+% in the US. You can sit there and get paid something to wait to see a better opportunity. Yep. So I'd probably prefer a cash to sovereign bonds, given the uncertainty I mentioned.
Okay, so you've got investment grade credit, select equities, and then cash.
Yeah.
Okay. What are you avoiding? So you talked about US equities, seemed really expensive. What else are you avoiding? What is not making it in that might usually be part of the mix?
So if you asked me that a few weeks ago, I would have said high yield credit, so yeah, global high yield. If you think about the US, the overall total yield is attractive, but the spreads were not compensating you for much. And I mentioned Australian IG was compensating you for more than a recession, whereas US high yield wasn't even giving you a recession. It was just a normal mid-cycle default rate. Yeah. So for us, that wasn't attractive. What's changed since then is spreads have widened, and the overall yield is actually quite attractive now, around 10%. And spreads or overall yields will have to move more than 2% in US high yield credit before you lose money over 12 months. So for us, it's becoming interesting, but it's not pricing in the wide spreads you'd expect to see given how tight financial conditions have been and how tight loan officer surveys are. So banks lending to the economy normally translates pretty closely to wider spreads, which we haven't seen. But all-in yields are quite attractive now. So we're nibbling away, but three weeks ago or 4 weeks ago, before those spreads widened, I would have said stay away from that asset classes, but now it's becoming a bit more interesting.
Okay. I want to wrap up with a question around your return targets, which is inflation plus 3 to 4%, if I'm correct?
4 to 5.
4 to 5%. Does a period of high inflation make you sweat hitting that return target? Do you need to take more risk and reach to go and hit those numbers?
Well, it's a really important question because I think people often think if your return target's rising, you should be taking more risk to get to that target. Now, for us, we don't want to take risk blindly just to reach a target. For us, it's about finding where's the best value, where's the best opportunity to make money. Yep. So think about 2022, inflation went really high. Inflation plus 5 was around 12%, but every asset class fell 20%. So unless you're in cash, US dollars, or commodities, it was very hard to make a positive return. So in those environments, rather than reaching for return, we try and actually reduce our risk to sort of muddle through the storm or survive downdrafts. So reducing drawdowns has been our main objective. For now, we are finding interesting opportunities in the medium-term horizon. Like I mentioned, investment-grade credits, and that's yielding 6-odd%. If you assume inflation normalizes back down to, say, 3%, and that's real 3 in IG credit.
Yeah.
So for us, it's about trying to achieve that target over a medium term, not just every year. And there are opportunities to invest in asset classes today that will get you there over the longer term. But what we haven't done is deploy massive amounts into equities. Because for us, we're waiting for a valuation opportunity to then reload up into risk to then get those returns. So long story short, no, we're not chasing those returns. We're trying to find best opportunities today, forward-looking, than just sort of blindly reallocating to risk to try and hit a target.
Okay, great. Well, Seb, thanks very much for coming in and sharing the work that you've been doing around valuations across asset classes globally and also what you're seeing in terms of the real economy and the prospect of recession.
Great. Thanks, James. Appreciate it.
To all you viewers out there, I hope you enjoyed that interview with Seb. Remember to check into our YouTube content. We're adding fresh content just like this every week.